SF Desk Brief, Deep Dive Audio, January 22nd, 2026. Before we begin, a quick note. Today's audio desk brief is free to everyone. Normally, these daily deep dive audio briefings are reserved for members, for people who want to understand how the silver market actually works, not just what price did on a chart. If you're someone who wants the nuts and bolts, physical flows, exchange mechanics, inventory stress, and how price discovery really happens, this is exactly what the SF Desk Brief is built for. The morning signal shows what moved silver. The SF Desk Brief explains why in depth, calmly, and without hype. Today, you're getting the full version. Silver is higher today, but the reason matters more than the move itself. This is not a momentum rally. It is not a technical breakout, and it is not being driven by headlines. What's moving silver today is physical stress building beneath the paper price, and that stress is now visible across multiple layers of the market at the same time. Let's walk through it. Start with where price is forming, not where it's reported. Overnight, silver tied to Shanghai traded above $104, while Western spot silver remains near $94. That difference is not noise. Shanghai pricing reflects physical delivery conditions. Western spot pricing reflects paper settlement conditions. When those two diverge and stay diverged, it tells you something important. The market is no longer clearing smoothly through arbitrage. If metal were freely available, traders would move silver from where it's cheap to where it's expensive, and that gap would close quickly. That is not happening, which brings us to the second layer. Inventory behavior confirms this is not simple relocation. At the same time that Shanghai pricing is pulling higher, inventories on both major exchange systems are declining. This matters more than most people realize. If silver were simply moving around the world, you would see COMEX inventories falling, Shanghai inventories rising. Instead, you're seeing COMEX inventories falling, Shanghai inventories falling. That tells us silver is not being shuffled between exchanges. It is leaving the exchange system altogether. That means it is being consumed by industry, locked up by long-term holders, or withheld from circulation, because availability matters more than price. This is why we keep coming back to the same structural truth. The market isn't moving silver around, it's using it up. Retail physical pricing confirms the same pressure. Now look one layer downstream. Recent APMEX listings show random date silver eagles trading above $106, even with spot silver near $94. Retail pricing always lags wholesale signals. When retail premiums rise and stay elevated, it usually means dealers are protecting inventory. Replenishment is slower than demand. Physical availability is tightening, not loosening. Retail does not lead markets, but it does confirm them. And today, it's confirming the same story we're seeing at the exchange level. Why this matters for price behavior. Base case, 55%. Silver continues to grind higher or hold gains, with volatility contained. Physical premiums remain elevated. Inventories continue to trend lower. And price action reflects structural pressure without a breakout. This is the most consistent outcome when physical stress is present, but paper markets are still absorbing it. Upside extension, 30%. Silver pushes higher intraday as physical signals begin to assert more influence over price discovery. This would likely occur without a headline catalyst and would reflect snap risk starting to express, not speculative momentum. Pullback/pause, 15%. Silver gives back part of the move as paper markets test liquidity and positioning. As long as physical premiums stay firm and inventories do not reverse, this would be considered noise within a tightening structure, not thesis failure. Silver does not reprice smoothly when structure tightens. It compresses, it frustrates, it trades sideways longer than expected. And then, when pressure becomes too great, it adjusts suddenly. This is what we call snap risk. The risk that paper prices catch up to physical reality in a short window, rather than over time. That does not require a catalyst. It does not require news. It only requires persistence. What would weaken this thesis? This is not belief-based. If Shanghai premiums compress, exchange inventories stabilize, retail premiums ease, then this structural pressure fades, and the market regains balance. Those are observable conditions. Until then, the stress remains. Bottom line, silver is higher today because physical availability is tightening globally, and price discovery is increasingly being led outside Western paper markets. Structure is building. Price historically follows, not gradually but suddenly. If this kind of explanation is valuable to you, the mechanics, not the hype, these daily SF Desk Briefs are published for members every trading day. The morning signal shows what's happening. The desk brief explains why. Today's audio was free, so you could experience the depth. We'll be back tomorrow with the next signal and the next deep dive.